All right, today we are diving deep into a really fascinating small cap stock that honestly seems to defy all logic. It's called Modern Malleables. Let's get right into it. And that really is the million-dollar question, isn't it? After an absolutely explosive run-up, the investing world is kind of split. Is there still some incredible, undiscovered potential here? Or is this just a classic value trap waiting to spring on unsuspecting investors? And this is exactly why it's on everyone's radar. A one-year return of over 638%. I mean, come on, a number that big doesn't just raise a few eyebrows. It practically screams for a closer look. So, this is where our investigation really begins. It's a 638% stock mystery. How on earth can a stock rally that hard and somehow still look cheap on paper? And this, right here, is the heart of the puzzle. Despite that insane rally, the stock's price is actually less than its book value. To put it simply, you can buy a piece of the company for less than the stated value of its assets. For any investor, that's a really confusing signal. Okay, so before we get any deeper into all these numbers, let's just take a step back for a second. Who is Modern Malleables? What do they actually do? So their business is actually pretty easy to get your head around. They work in the engineering and casting industry, which basically means they make iron castings and other industrial parts. They then sell these components directly to other big companies. It's a capital-intensive business, meaning it requires a lot of heavy, expensive machinery to get the job done. All right, so here it is. Think of this as our official case file. This has all the key data points we need to dissect. You've got the price, that massive return we talked about, a pretty small market cap at 142 crores, and look at that PE ratio, super low at 6.66. And there's the book value again, over 15 rupees. And check this out, the debt to equity and the industry's PE. We're going to circle back to all of this. Okay. First, let's put on our optimist hats. Let's build the case for this stock being a massive opportunity. What are the people who are bullish on this company seeing? The first piece of evidence, and it's a big one, the stock is trading below its book value. For most healthy companies, you almost always expect to pay a premium for their assets, right? Seeing it this way suggests the market might have just missed something here, that the company's real worth hasn't been recognized yet. And clue number 2 is just as compelling. The company's price-to-earnings ratio is under 7, while the rest of the industry is chugging along at almost 50. That is a huge gap. It suggests that, compared to how much it earns, Modern Malleables is way, way cheaper than its competitors. It just begs the question, why? But this next point might be the real kicker for anyone bullish on the stock, that debt-to-equity ratio. A ratio of 0.01? I mean, that's practically zero. The company is virtually debt-free. In an industry that needs a lot of heavy, expensive equipment, where smaller companies are often drowning in debt, being debt-free is like having a superpower. It gives them so much flexibility. And finally, you've just got the built-in advantages of being the small company. Smaller players can be way more nimble than the huge corporations. They can have more flexible production, their overhead costs are lower, and they can serve these really specific niche markets that the big guys ignore. If a company like this can just improve its profit margins a little bit, its earnings could grow like crazy. But of course, every story has two sides. So now we have to investigate the other possibility. Let's make the case for this whole thing being a trap, and why that 638% rally might actually be a huge warning sign. Okay, so let's talk red flags. First off, small caps are just volatile by nature. That's part of the game. Plus, there's low liquidity risk, which means trying to sell your shares quickly without crashing the price can be tricky. Second, after a 638% run, the danger of profit booking, where all the early investors decide to cash out at once, is very real. Then there's the return on equity. At 9.42%, it's okay, but it's not going to blow you away. And finally, with any stock that shoots up this fast, you have to consider the risk of operator activity, where the price might be getting artificially, well, let's just say helped along. So, where does all this leave us? We've got some really compelling evidence on both sides of the aisle. What's the final verdict in this financial mystery? A hopeful way to make sense of this is to try and categorize it. This isn't just pure speculation, because the fundamentals aren't terrible, but it's also definitely not a guaranteed blue chip winner. It fits really well into a category we can call a deep value small cap with momentum. It has the low valuation, the small size, and that undeniable recent performance. Just understanding that category helps you frame both the risk and the potential reward here. So, if this has piqued your interest and you want to continue your own research, here are the key things I'd be watching. Keep an eye out for any news about their order book. Are they getting more customers? Watch their profit margins like a hawk to see if they're improving. The next quarterly results are going to be absolutely critical. And finally, pay attention to the trading volume for any unusual spikes or dips. And that brings us right back to where we started. After weighing all the evidence, the deep value versus the high risk, the zero debt versus that massive rally, what do you think? Is modern Malleables a future value stock just waiting to be discovered, or is it a high-risk trap? The answer really depends on which pieces of evidence you believe are the most important.